The Indian stock market has emerged as a global powerhouse, reflecting the country's remarkable economic transformation. As India has integrated with the global economy, its stock market has become increasingly intertwined with global financial forces. This essay explores the relationship between the Indian stock market and major global recessions since 1950. We will delve into significant economic downturns. The 1973-74 oil crisis, Black Monday in 1987, the Asian financial crisis in 1997, the dot-com bubble in 2000, the global financial crisis from 2007 to 2008, and the COVID-19 pandemic in 2020. Each recession offers insights into the resilience and vulnerability of the Indian stock market. Understanding these impacts is crucial for investors and policymakers. By analyzing trends, we gain perspectives on risk management and investment strategies. This analysis focuses on benchmark indices like the BSE Sensex and Nifty 50. Through charts and data, we illustrate the market's reactions to each recession. The Indian stock market, one of the oldest in Asia, has witnessed remarkable growth and transformation. From a modest beginning, it has evolved into a sophisticated financial system. At the heart of this market are the Bombay Stock Exchange, or BSE, and the National Stock Exchange of India, or NSE. The BSE, established in 1875, is home to the iconic Sensex index. The NSE, established in 1992, introduced the Nifty 50 index. The Indian stock market has witnessed increasing integration with global markets. This integration has brought greater access to foreign capital and technological advancements. However, it has also made the Indian market more susceptible to global economic shocks. Today, the Indian stock market is a significant player in the global financial landscape. The 1973-74 oil crisis, triggered by geopolitical tensions in the Middle East, sent shockwaves through the global economy. The Organization of Arab Petroleum Exporting Countries, or OAPEC, imposed an oil embargo, leading to a quadrupling of oil prices. This unprecedented surge in energy costs fueled inflation and slowed economic activity worldwide. However, the impact of the oil crisis on the Indian stock market was relatively muted. India, at the time, was a closed economy with limited exposure to global trade. The government's socialist policies shielded the domestic market from external shocks. The BSE Sensex, during this period, experienced a moderate decline but recovered relatively quickly. This resilience can be attributed to several factors, including low dependence on foreign oil, government price controls on essential commodities, and a focus on domestic consumption. The oil crisis served as an early indicator of the potential impact of global events on the Indian stock market. It highlighted the importance of energy security, economic self-reliance, and the need for policy measures to mitigate external shocks. Section 4. Weathering the Storm. The 1980s Recession. The 1980s witnessed a period of global economic stagnation, often referred to as the 1980s Recession. This downturn was characterized by high inflation, rising interest rates, and sluggish economic growth. Several factors contributed to this recession, including tight monetary policies by the US Federal Reserve to combat inflation and the Latin American debt crisis. The Indian stock market, during this period, faced a challenging environment. High interest rates and inflationary pressures impacted corporate profitability, leading to a decline in market sentiment. However, the Indian economy was undergoing structural reforms, including deregulation and liberalization measures. The BSE Sensex, while experiencing volatility, managed to weather the storm and emerged from the recession with moderate losses. The government's gradual economic reforms, coupled with a growing middle class and increasing domestic demand, provided a buffer against the global downturn. The 1980s recession highlighted the importance of structural reforms, domestic economic resilience, and the need for a balanced approach to managing inflation and growth. It also underlined the growing interconnectedness of the Indian economy with global trends. Section 5. Black Monday, a fleeting tremor in 1987. Black Monday, on October 19, 1987, witnessed the largest one-day percentage drop in the Dow Jones Industrial Average, sending shockwaves across global financial markets. This sudden crash was attributed to a confluence of factors, including program trading, overvaluation, and a lack of investor confidence. The Indian stock market, still in its nascent stage of global integration, experienced a sharp decline in the immediate aftermath of Black Monday. However, the impact was short-lived, and the market recovered swiftly, demonstrating its resilience and ability to decouple from global shocks. Several factors contributed to India's quick recovery, including strong domestic economic fundamentals, limited foreign institutional investor participation, and government measures to stabilize the market. The Reserve Bank of India played a crucial role by providing liquidity and ensuring financial stability. Black Monday served as a reminder of the inherent volatility in financial markets and the importance of risk management. It also demonstrated the growing resilience of the Indian stock market and its ability to withstand external shocks. Section 6. The Asian Financial Crisis, a test of resilience in 1997. The Asian financial crisis, which originated in Thailand in 1997, quickly spread across Southeast Asia, impacting several emerging economies. The crisis was triggered by a combination of factors, including excessive borrowing, currency speculation, and weak financial regulations. The Indian stock market, while not immune to the contagion effect, weathered the Asian financial crisis relatively well. The BSE Sensex experienced a moderate decline but recovered faster than many of its Asian counterparts. India's strong economic fundamentals, robust banking system, and proactive policy response helped mitigate the crisis's impact. The Reserve Bank of India played a pivotal role by implementing measures to stabilize the rupee, manage capital flows, and maintain financial stability. The government also introduced structural reforms to strengthen the financial sector and improve corporate governance. The Asian financial crisis underscored the importance of sound macroeconomic management, a robust financial system, and prudent regulation to navigate global financial turmoil. It also demonstrated the growing resilience of the Indian economy and its ability to withstand external shocks.